everyone. All right, we're back to another day of Fibonacci madness. All right, welcome once again. Welcome once again to our XC Trader webinar today. Right, today once again you have me, you have me, and you have been having me for the past I don't know how many months, right? But today we'll be exploring a very interesting topic. Right, it is. We've always talked on Fibonacci retracement, but we haven't really moved into Fibonacci extensions, which, if you ask me, is slightly more difficult than Fibonacci retracements because you need to use not only 2 points, but you need to use 3 points to find a good level. Right. So all right. Anyway, before I begin, once again, nice to see you guys. I see a couple of familiar faces here, familiar names, and I'm really glad to hear that. Remember, a reminder is that there is there's a chat function, there's a question panel, all right, that you have, right? I can see Alessandro, you're saying hi, right? Nice to meet you again. This session, I'll try to go a little bit slower, but if you have a question, straight away ask it. Okay, that is the one thing I request from you. Straight away ask it, because as you know, most of the time, we rarely have time at the end of the webinar to slowly go through things together. So we have 1 hour, and let's make the most out of the 1 hour we have together. Okay? Now, anyway, our agenda for today, Fibonacci extensions. All right. Can you trade using Fibonacci extensions alone? Right? Is it enough to have to create a profitable trading strategy using Fibonacci extensions alone? Right? What are the important Fibonacci extension ratios? There are many of them, right? But personally, tried and tested, there are some levels that work better and some that don't work as well, right? We'll help you understand the Fibonacci extension, right? It's slightly more difficult to use, but that doesn't mean that it's as long as you follow a few key principles, a few key rules, right? You can really learn how to use it properly. All right. Give me a second. There's something wrong with my chat panel, right? I can't see. I can only see. I can't see everyone's. I can only see a couple of messages. Let me. Okay, I can see it now. All right, I can see Imat back here. Nice to see you guys. I can see Tony. All right, Victor. Oh wow, quite a number of you guys. Right. So we got a question from MapDoc. Is this going to be an advanced trading strategy? Is it going to be too advanced? It's advanced, but I'm going to try and make it as easy as possible. Right. I can't promise that you at the end of it you already fully understand it. Right. But I hope you did a little bit of your homework. I'll try to explain things to the best of my abilities. All right. Now let's anyway, yes, we'll talk about finding Fibonacci confluence. Previously in our last week webinar, we looked at how we can do Fibonacci confluence with Fibonacci retracements. Today we'll be looking at it on how we can do retracements and extensions. Pretty exciting stuff and pretty fun too. All right. Then now we look at strengthening your strategy with support, resistance, RSI, right? And then we have a giveaway at the end. I hope we can finish everything today, right? But it's going to be another exciting hour, right? So anyway, once again, a little bit of an introduction to myself, right? I run Everest Fortune Group. We're award-winning research team, best FX and best equity research in 2019 and 2020, and we are a certified Singapore fintech company, right? We do a lot of research for many banks, brokers, hedge funds, right? And we're on radios often. So if you so today, I'll be sharing with you one of the big secrets we have to finding good analysis, and that is Fibonacci extensions. Okay. Now, once again, disclaimer, guys, trading CFDs, high risk, right? Always do your own research before you trade. Nothing in this webinar should be construed as investment advice. So please do your own research before you trade, right? You can ask me as many questions as possible, and I'll do my best to kind of look through the markets with you. Today's session is not a live trading session, but I will try to look at some live markets if time permits. Okay, and yeah, nice to see you, Bian. Is that how you pronounce your name, Bian Benito? Okay, now, can you trade with Fibonacci extensions alone? No, you can't, right? Short answer to a short question, but the long answer to it is that there is a Fibonacci extension level at literally every single at every single place, right? However you draw it, there's going to be a Fibonacci extension level. I'm going to show you this, right? Wherever you draw it, there'll always be a Fibonacci extension level. You know, you draw it, however you draw it, you know, there's going to be a 23, 38, 50, 61.8, 78.6, 80, 100%, 127, 161.8. There's going to be a Fibonacci extension everywhere. Same as a Fibonacci retracement, right? The trick is not to trade them unless they all line up nicely, right? And I'll be showing you examples of how that works later, right? But the key thing first is that you cannot trade with extensions alone, but you can trade well with retracements and extensions, right? I have Sharon saying that she can't see the screen. Can you guys see my screen? Can you guys see my screen? Oh, I'm getting a lot of no's. Yeah. Okay. Phew. Okay, you can see. Now everyone can see, right? Everyone can see? Okay, sweet. All right. Thank you, Sharon. If not, we went on 1 hour without realizing that. All right, but okay, cool. Yeah, so a Fibonacci extension, notice when you draw it, there's going to be so many different levels, right? So many different levels. And if you trade on every single level, imagine if you tried to trade the 23, 38, 50, 61.8, 78.6, 88, 100, you have lost a lot of money, right? You have lost a lot of money, right? So the trick is in finding levels that line up nicely together, right? Retracement extensions, those are the two main important things for me. You combine it, right? You combine it with support resistance, stochastic RSI, the proper way to use them, right? And you get a much more profitable trading strategy. Okay, so now don't want to digress too much again. Important Fibonacci extension ratios. Okay, now who wants to take a guess and tell me what you think is the most important Fibonacci extension ratio? Unlike retracements, there are actually certain extensions that work pretty well, right? So that's the interesting thing between retracements and extensions. There are some extension ratios that work a little bit better. Anyone want to take a guess and tell me what Fibonacci extension level works quite well? Oh man, I finished my tea and we're only 8 minutes in. I'm in trouble. Okay, we got people who say 0%. Mark, how do you do a 0% Fibonacci extension, man? How does that work? How does that work, man? How do you do a 0% extension? All right, we got 23.6, we got 1.61, we got 161%. Ah, I never heard of that. I heard of, okay, if you mean the 100, okay, 161.8, not 161.1, okay? 68.2, 100%, 78.6. Oh, I like Fran's answer, right? There's one guy who says 78.6 here. You got your Gendra saying 78.6. Henry is saying 127, 138, and 161. Okay. We got 27%. We got 27% coming in, 127. Okay, I notice not many of you guys say 100%. Right, we got a couple of you guys saying 27, 30, 32. Now, let me share with you what I think the important Fibonacci ratios are, right? These are the important Fibonacci ratios, the ones in the middle. That's not to say that the 38, 50, 127, and 161.8 are not effective. You'll notice I don't have 138, 150, or 261.8. The reason why I don't like extensions that are too far away has a little bit to do with market structure. Let me just give you a quick understanding of that. Why I don't like Fibonacci extensions that are maybe why I don't like Fibonacci extensions that are too far away. For example, let's do a Fibonacci extension from here, right? If it's from here to here to here, you're projecting it far away, right? If you have a Fibonacci extension that goes up to we got 161.8, we got 2.618 even, right? You'll notice, right, for a Fibonacci extension, for a Fibonacci extension to be good, right? It needs to follow the market structure very closely, right? Even though this 261.8 looks like there was a nice reaction off here, you shouldn't be tricked by that. You know, it could be for any other reason. It could be this Fibonacci extension here that caused this nice reaction over here, right? But what I want to share with you is that usually for such longer term extension, right, price just doesn't have the chance to go all the way up there in a clear move, right? Usually when you're looking at the smaller numbers all the way to 100%, right, price does have the chance to reach there with a clear market structure. The bigger the number is, the further price needs to travel before it reaches there, and the more chance it gets to do something like this, right? You know, see, it comes down here and it comes up. What I'm trying to share with you is that this movement here, this Fibonacci extension, should not be mistaken for this same Fibonacci extension up here, right? One important rule which I always want to share with you: look for zigzags, right? Look for zigzags. The magic is in the zigzag. The clearer your zigzag, the better your Fibonacci extension, the better your Fibonacci retracement. Okay, so whenever the zigzag goes a little bit too far, like this, you know, zigzag, and then it goes down again, right? It just doesn't make the initial extension proper. I'll be testing you guys a bit, you know, asking you guys questions a little bit later. But before we jump into that, these are the important Fibonacci extension levels I want to share with you, right? 61.8, 78.6, 88, and 100%. These four, all of the Fibonacci extension levels there are valid, okay? But what I feel are personally the stronger levels are these four. Within these four, the two strongest is 78.6 and 100%. And if I have to pick the strongest one among all, it will actually be 78.6. It's funny, right? It's very funny, but somehow 78.6 works even better than the popular 100%. Right. So how does a Fibonacci extension work? I can share with you guys very quickly. Sorry about that. Yeah. How a Fibonacci extension works is like this. Maybe we let me think. Okay. If this is the starting point and this is the middle point. Okay, we got a question from Tafatswa. He's a little bit confused. He's saying, why do you call them Fibonacci extensions? I thought the market is retracing 0 to 100%, and that extensions are beyond 100%. Now, that is where you get confused between Fibonacci retracements and Fibonacci extensions, right? So look closely. There is this thing here that is called a Fibonacci retracement. There's this thing here that is called a Fibonacci extension. Okay, Fibonacci retracements got only two levels. You pick one level here, and you pick another level there. Technically, strictly speaking, right, extensions can be like in this region over here, right, where it goes beyond the normal 0 to 100%, and it can go beyond. It can go to 127. It can go to 161.8, right? So how that works is that, you know, price comes up here, and then it reverses. It retraces to 100%. It reaches beyond 100%. So in some traditional camps of thought, right, they say yes, technically it's an extension, right? These areas over here and these areas over here are technically Fibonacci extensions. But strictly speaking, there's a different kind of Fibonacci extension, right? One where, like I mentioned, and I warned you from the beginning, right, it's a little bit more complicated because you're not only picking a starting point and an ending point, and you're not only sticking to your familiar Fibonacci retracements, right? A Fibonacci retracement has 1 and 2. All you're looking at is the retracement from this distance, the vertical distance from 1 to 2. Correct? You're just looking at you're just looking at this. A Fibonacci retracement has 2 points. A Fibonacci extension has 3 points, right? I'm going to show it to you here. You notice when I pick a Fibonacci extension, I'll pick 1 point here, I'll pick another point here, and I'll pick a third point. Now, what in the world is a Fibonacci extension in this case? A Fibonacci extension basically projects the distance, right? It projects, just give me a second. Let me see if I can, let me see if I can change the symbol a bit. Sorry, I had a private message coming through. Right, how a Fibonacci extension works is that it just give me a second, guys. Just give me a second. Indicate values symbol. Okay, got it. Sorry. Yeah. Sorry, compliance reasons. Anyway, guys. Okay, back to this. How a Fibonacci extension works is very simple, right? We are taking. Now I'm just going to draw it to you here. Imagine if this is a move, this is a move, this is a move, this is. Okay, we are taking the distance from here to here, like starting point, middle point, and ending point. Okay, we are taking the vertical distance from here down to here, right? So that is what the first 2 points is for. You're taking the first vertical distance. So assume this is 100 pips. Okay, you're taking the vertical distance of the first move and you're projecting it from here. Okay, so if this is 100%, that means that you can see this is 100%, right? One. That means the distance from here all the way to here is 100. Okay, a 61.8 extension means that the distance from here to here is 61.8 units. So the difference between a retracement and extension. Oh wait, okay, I got Highton saying that my cursor and arrow is not moving when I'm explaining. Guys, can you see what I'm drawing? Can you guys see what I'm drawing? Okay, so Highton, it might be your computer, right? Because I can see the majority of people are saying that they can see what I'm drawing. So yep, it might be your computer. But anyway, right? So that's how extension works. Extension, basically you take one distance and you project it into the future. So it becomes this distance. Oops. Yeah, it becomes this distance. You project it into the future. That's how a Fibonacci extension works, right? You're not looking at retracements anymore. You're looking at extensions, right? And if you can combine retracements and extensions, that is where magic happens. Okay, that's where magic happens. Okay, now that you got a little bit of understanding of Fibonacci extensions, I'll be diving a little bit deeper into it later. I just want to share with you guys a little bit about market structure. Now, can you guys just give me a quick raise of hands, or not raise of hands, but rather just type it in the chat quickly. If you had attended the previous webinar on Fibonacci retracements, right? I just kind of want to know who attended, so I know whether I'm like covering double or something, right? Okay, we are getting a pretty mixed response, right? Yeah, we're getting a pretty mixed response. Actually, majority of guys say no. Oh man, if it's no, it's gonna be tough to explain this. But all right, then I'll touch on this part of market structure. It's a good thing to look at because let me just find that this thing called to understand the Fibonacci extension or how we draw any retracement or any extension, you need to understand the concept of market structure, clear market structure. Okay, because some of you guys attended this before, I will go through this really quickly. Okay, if you have unclear market structure, it is very difficult to draw Fibonacci retracements or Fibonacci extensions, and this is one of the reasons why. Imagine you're drawing Fibonacci retracement. I'm just going to use my pen over here. This is the starting point of, okay, yellow's not good choice. Go pick a pen color, maybe red, right? This is your starting point, and this is your ending point, right? When there's unclear market structure, right? Firstly, what you always notice is that there is a lot of wicks, right? There are these long wicks everywhere, Now, what is the problem with these wicks, right? A starting point of a Fibonacci retracement from here down to here is very different from a Fibonacci retracement that starts from here down to here. Okay, the reason for that is because when there are such big wicks, it tells me that there's a lot of indecision, there's a lot of volatility that is happening in the market, right? And technical analysis requires the fundamental rule of technical analysis is that when more people are on your side, when more people are buying than selling, there's a higher chance that price will rise, right? You need more people to agree on a certain style of analysis for it to work effectively, right? So imagine this, you need more people to agree with your analysis for it to work effectively. But how can that happen if 20% of traders decide this is the top, another 20% decide this is the top, another 20% decide this is the top, right? The reason that happens is because different brokers have different price feed. It's not like a centralized exchange like the stock market, right? So the truth is that different brokers, sometimes some are a little bit higher, some a little bit lower. It's just the nature of the market and the liquidity providers. So when you see such big price wicks, right, it's usually a bad place to, it's usually not the best to draw Fibonacci retracements and extensions from there. You probably won't be as accurate, right? Instead, what you want to look out for are clearer kind of market structures, right? Clearer kind of market structures like this, right? Where you can see very clearly, price moving up and down, up and down. When you want to take a retracement or extension, it is very clear, okay? Now, how do you get to this? It's very simple. Usually, when you're on the lower time frame, right? Maybe we have something like pound Aussie, right? And pound Aussie, most of you guys are on like the 5-minute time frame. Actually, a 5-minute time frame is quite okay for pound Aussie. So on the 5-minute time frame, you notice stuff like this kind of very big spikes down, this kind of ups, downs, and it's very difficult to draw Fibonacci retracements with such inconsistencies, because someone might think that one broker might show that this is the low, another broker might show this is the low, right? One broker might say this is a spike, another broker might not even have the spike, right? So on the lower time frame, where there's more noise, there's more chaos that kind of happens, you see a lot more of this happening, right? But if you go into the higher time frame, where you go into the higher time frame, oh my goodness, like you'll notice there's less of that, right? Apart from this big spike up here, right? But if you look at it, right, the market is generally much more structured, right? It's a lot more structured. You have less space or really big spikes because that's just the nature of the market, right? The higher time frame you are, the higher your time frame, the better your, what's the word for it? The less noise you have, okay? And then the clearer your structures are. You compare this with what you saw on the 5-minute charts earlier, okay? So when it comes to drawing Fibonacci retracements or extensions, one thing you always have to take note of is that you are looking for clear market structure. Okay, now same thing with retracements and extensions. I'm going back to one of my favorite currency pairs, Aussie franc. All right, same thing with Fibonacci retracements or extensions. One guiding principle which you should always use, right? Sorry, I just need to go back to my 1-hour chart. One of the guiding principles that you always want to use is that whether you draw a retracement or extension, price needs to follow. No, the extension needs to follow price very well. What does it mean? If this is my starting point, this is my middle point, and this is my ending point. I'm going to zoom in I'm going to zoom in for you guys, right? You will notice that I have this, there's this little dotted line over here. This is what I call like a trend line. Shoots, right? This is like what I call like a trend line. The closer price follows it, the better. Okay, so in this case, we can see that price kind of follows it quite well, apart from a little bit of here and a little bit of here, right? So this area, it kind of deviated away. right? So the closer price follows your trend line, the better and more effective your Fibonacci extension is going to be. The better and more effective your Fibonacci retracement is going to be, right? What is the opposite? The opposite, right, is maybe something like this. Let me see if I can pick it. All right. This is what I mean by a bad structure. I'm just going to zoom in for you guys, right? If this was my, I'm just going to use a pen here. If this is my key level over here, this is my trend line. Price is supposed to follow it as closely as possible. But look at this big move here. Look at this big move here, right? What is this space over here? What is this space over here, right? Same thing as here. What is this space? What is this space? What is this space? And what is this space over here, right? Because of that, right, the effectiveness of your Fibonacci extension, the effectiveness of your Fibonacci retracement is going to be weaker, right? Because price is, you're just not following, you are trying to force the market into your structure, right? You're trying to force the market into into this kind of structure, and it's not very good. Okay, so sorry, I need to erase this. So that's one thing I want you to know. Okay, now so let me just see if I can find a couple more examples. Like in this example here, a nice structure is this zigzag that happens 1, 2, and then it comes all the way down. Okay, what is not so nice is if you use this structure, this and then this, right? The same reason for that, you can see that there's a very big gap over here, gap over here, gap, and a gap over here, right? So that's one key thing to look out for when you're drawing Fibonacci extensions. Okay, now I hope you guys are still with me, right, and understand the concept. If you at any point of time, like I mentioned, if you don't understand, just feel free to ping me, put it in the questions, and I'll do my best to answer them as quickly as possible. Okay, now anyway, back to this. All right, finding Fibonacci confluence, right? Finding Fibonacci confluence. Okay, we got a question from Stephen Bryan. So using the daily or longer time frame, you should get a smoother trend line. Yes, you should have a smoother trend line. At the same time, don't try to force a trend line, right? What I mean by this is that this is how my charts look like every day. I literally have all these things open, right? Shoots, man. I literally have all the different markets open, and if I see something as messy as this, I won't even bother, right? So because I trade on the 1 hour chart, I will zoom out to the 4 hour chart, and I'll kind of be looking at market structure, right? And if I see something like this, I'll be like, I see this nice little pattern over here. It looks like it might work out nicely, right? And when that happens, I click on it, I expand it, I zoom into the 1 hour chart, right? And I see, true enough, there's a very nice market zigzag over here. Maybe you got potential trade coming up over here, right? So usually I look at the higher time frame to kind of filter, right? But if you're really trying to trade Fibonacci extensions, 5 minutes, 15 minutes don't work very well. 30 minutes are the bare minimum. I usually prefer to go to 1 hour charts to look at Fibonacci extension, so there's less noise. Okay. Now, okay, let's see. Finding Fibonacci confluence. Okay, Fibonacci confluence is the art of lining up multiple Fibonacci levels together to find a strong area of support or resistance. Okay, now this is one example of Fibonacci confluence, and don't get terrified by it yet. I will explain it to you very slowly. Okay, I'm going to take out my trusty highlighter. Now, if this is the starting point and this is the middle point, we're drawing a Fibonacci extension, starting point to middle point, and this is the ending point. Remember, we're looking at something like a zigzag. Price projects upwards, we find an 88% Fibonacci retracement. Now we do a simple Fibonacci, 88% Fibonacci extension, right? Now we got a starting point over here, all the way to an ending point over here. we find a 61.8 Fibonacci retracement as indicated by the teal highlighted area. Last one, we got a red one, starting point, middle point, ending point, a Fibonacci extension upwards, right? We got a 61.8 Fibonacci extension over here. So you know what, like Captain Planet says, right? We got the 88% extension, 61.8% retracement, 61.8 extension. All three levels lining up closely towards this area over here. What is likely to happen, right? Initially, right, we might have a probability of maybe this is a 40% chance of a successful reversal, right? You add in this, you have another 20% chance. Oh, sorry, same thing. You add in this, you have a 20% chance. You add in this, you have another plus maybe a 10% chance. By themselves, they don't stand much of a chance for a successful trade to occur, right? But if you add them up together, 40% plus 20% plus 10%, 40, 50, 60, 70, you know, you have a 70% chance of a successful reversal when price reaches here and goes down. Okay? So that is the concept behind Fibonacci confluence. By themselves, a single Fibonacci extension, a single Fibonacci retracement will not be strong enough. But the more you add them up together, the stronger it will be. So last week we touched on the topic of Fibonacci retracements only, right? And maybe you will not be able to find that many Fibonacci retracements, right? Because it's very single dimension, right? But once you throw in Fibonacci extensions on top of your Fibonacci retracements, that's where it becomes even more powerful. You find many areas of strong confluence. Okay, and this is what happens, right? I'm just gonna erase all drawings, right? This is what happens. There you go. You can see price went all the way up to here, and then it reversed from there, reversed down, right? That's exactly the style of Fibonacci confluence trading strategy that we're looking out for, right? You look for, you combine retracements and extensions, and you find a single area, and then you try to play a reversal from there. Okay, let me see if I got another example to show you. Yes, I do. I do have one more example, but I guess I'll show it to you now. This is the same. Oh, we got a quick question from David. Is it better at H4 or D1? Usually the higher time frame it is, the better. But sometimes if you're trading on D1, right, it is good to use the daily time frame more to find the overall direction of the market, right? And then you go into the 4-hour when you're looking at where you're looking to trade maybe a swing trade, that you hold a trade for a couple of days, right? The good thing with let me just show you. If I were to do an analysis on a daily time frame, right, the main reason I'll do it is to kind of just identify key levels, right? So I will go to the daily time frame like this. I will zoom out all the way and I'll see what I can find. Okay, so I'll be doing a Fibonacci extension from here up to here, down to here. Okay, then I'll kind of just highlight the key levels, look out for key levels, a big retracement all the way down to here, right? And I'll see if there's any big levels. Actually, I don't like this market too much. Let's try to look at pound dollar maybe. Okay, this is the reason why I'll do a Fibonacci extension. No, I'll look at the daily time frame. It allows me to look at things from a much bigger perspective, right? Let me show you. I'll probably do an extension over here, a nice little zigzag all the way down to here. You can see it reacted off the 88%. Initially reacted off the 78% very nicely before reacting off the 88%. Now, I'm just looking at this and, okay, I'm going to do a Fibonacci retracement from here to here. I noticed that there are nice levels lining up over here, right? So if I would probably just highlight this area as a key area to look out for. Okay, once I'm done with the big time frame, then I go down to the 4-hour chart, right? So you notice, like on the 4-hour chart, this looks massive, right? But on the daily time frame, it's just like a small little thing. It's just a small little part of the analysis, right? I identified this as a big area. Right? So now I do my smaller time frame analysis, right? So I'm over here now and decide to do a Fibonacci extension on this zigzag, and I realize that there's a 100% extension. I'm not sure if you can see, but there's a 100% extension that lines up nicely with my big long-term 78.6 and 100% extension, right? So that's the benefit of doing a higher time frame to a lower time frame kind of analysis, right? You look at the big picture. The big picture allows you to see something which I probably wouldn't see if I was on the 4-hour chart. Even more unlikely to see if I was on the 1-hour chart. You look at all these lines everywhere, right? I wouldn't even know that there was like, my screen can't even zoom out far enough for me to see the bigger time frame, right? But on a daily time frame, this is very, let me show you. On a daily time frame, this is like super small to me, right? This little extension area is very small to me, right? So that's how I do it. You know, I use the bigger time frame just to watch out for the key things, right? It'll be pretty hard to trade on the bigger time frame because even if I identify a level over here, it'll take months before it reaches there, or maybe weeks. But at least it lets me know that there's a big level there. And when I come to 4-hour chart, I can zoom in a little bit more, right? Like this, I can zoom in a little bit more and fine tune my entry. Oh, sorry. Yeah, so I can fine tune my entry so that I notice there's a 100% extension that lines up nicely with a higher time frame. Okay, long answer to a short question. So it's not whether H4 or D1 is better, right? It's about combining them together so that you can, you know, you get a bigger, you're not blindsided by zooming in too much on the chart, right? The biggest danger is when you zoom in too much on the chart and then you feel like that's all you're looking at, right? I can zoom in and think that that's all I'm looking at over here, but I don't realize that on a higher time frame, there's a super duper important level. So that's the importance of a top-down kind of analysis style. Now, okay, I digress again. Of this Fibonacci extension, this is another example, right? This is another example over here. Our starting point is over here. Our ending point is over here. Fibonacci retracement identifies a 61.8 retracement here. Not only is there a 61.8 retracement, but it lines up very nicely with this, right? It comes and it breaks back. So what is this level over here? When price is coming back to it, it's called a pullback resistance, right? So if you've been through our support and resistance, right? If you've been through our support and resistance webinar, you will know that this is what we call a pullback resistance. And it's one of the better, it's one of the stronger kind of resistance levels to look out for. Okay, now, so we have a 61.8 retracement, right? If you do another retracement as starting point, ending point, we have a 241.4% retracement. You do a Fibonacci extension, starting, middle, end, you have a 161.8. So the combined area, you have pullback resistance, 61 point extension, 161.8 extension, 241.4 retracement. All of it lining up very nicely over here. Okay, so a Fibonacci confluence strategy would require you to, you know, come up and you play the reversal from there. Okay, now we have a question from Bruce. I'll answer that later. I can show you how a previous analysis and the result of previous analysis, right? It'll be a little bit difficult, right? But I'll do my best to kind of show it to you. But anyway, right? So let's see, erase all drawings. So the outcome of that is that yes, price rose, tested the extension area, no, tested the big confluence area over here, and reversed very nicely over here, right? So that is the trick behind using not only retracements and extensions, but also using support and resistance, right? To find using support and resistance to find good good areas to trade from. Confluence is the key thing that you're looking for. Now, if you attended my previous webinar, right, I'm gonna explain to you the concept of scalping, right? A lot of you guys have asked me, Desmond, how many pips do I trade, right? Do you go for 100 pips? Do you go for 200 pips? Basically, Like what is the ideal amount of pips to go for when you're going for such a trade? I can honestly tell you I'm a scalper, and my style of trading is to get in and out very fast. But before I go into that and I explain a little bit more of my trading strategy to you, right? I want to ask you, and those who attended my webinar last week, right? You can go through this exercise again, right? I won't try to take out too much time on it, but what I do want to ensure is that everyone here has an understanding of how a trading strategy works, right? This is the first setup: 50 pips stop loss and 90 pip take profit. Okay, 50 pip stop loss and 90 pip take profit. This is the second: 20 pip stop loss, 36 pip take profit. Okay, I'm going to write it here for you. The first one is 90 pips of take profit and 50 pip stop loss. The second one is 20 pip stop loss, 20 pip stop loss and a 36 pip take profit. Which trading strategy is going to make you more money? Is it this one, number one, or is it this one, number two? Which trading strategy is going to make you more money? Guys, participate in me here. Answer one or two. We're getting a lot of different answers. You get a lot of number ones, you get a lot of number twos, right? I like some answers coming in, right? From Christian saying that it's a ratio, depends on your win rate. Oh man, I'm so worried, guys. I'm so worried. I see so many of the answers here. I'm glad that I see some people who answer that it's the same. Now, whoever's answered one or whoever answered two, do me a favor. Divide 90 by 50 and divide 36 by 20. What is your answer? Go through this exercise with me to really realize. Okay, we got the answers 1.8. Yeah, the answer is 1.8, guys. So what is the amazing thing here? Both of them have the same risk to reward. That means if you risk 1% on this and you risk 1% on this, both of you will have led to 1.8% return. Okay, one has 90 pips take profit, one has 36 pips take profit. So this is the big lie that many forex gurus out there, right? Many educators, many I don't know, many people on Instagram on baby pips. That's all they ever talk about. They say, oh, I made 100 pips, right? I made 200 pips. Like, you know, don't hate the game, you know, don't hate the player, you know, hate the game or something like that, right? It's so many of them out there that do that, right? And it's very bad because it really frustrates me, man. It really frustrates me that people are falling for it. They think that just because you have more pips in profit, you're gonna make more money, right? I tell most people that my take profit is 10 pips, and they look at me and they're like, "Are you crazy? Right? How are you ever gonna be? How you ever gonna buy that Lamborghini? You know, if you only have 10 pips of take profit, right?" It's crazy. I'm very realistic. I'm very realistic. I'm very blunt, right? And I can be very frank with you that it's not about the pips. It's about the risk to reward, right? I can tell you that I make 10 pips per trade, right? But if my stop loss is 2 pips, that means my risk to reward is 5 times. And that is almost 3 times better than this. Okay? It's almost 3 times better than this. So that is important thing to take note of, guys. It's not just the stop loss to take. It's not only the pips that you make. It's how much you risk to get that 90 pips of profit. Is how much you risk to get that 36 pips of profit. Okay. Always look at how much it is. next time you see someone saying he made, he made 100 pips, ask him what was your stop loss on that trade, right? If your stop loss was 10 pips and you made a risk reward of 1:10, amazing. But if your stop loss was 1,000 pips or worse, you have, a lot of people, they have 100 pips take profit, but they have infinity stop loss. They don't have a stop loss, right? The risk to reward for this is terrible, right? Because all it takes is one trade to go against them and their account is wiped out. So that's why it always looks very good when you trade without a stop loss. You're bagging wins, but all it takes is one trade to go against you, not as you plan, and then your infinity take profit stop loss is gonna cause you to burn a big hole in your pocket, right? So we got a question, but one has greater variability, right? Amy is saying, how do you decide which of these to use at that time, right? How do you decide when to use a 90-50, when to use 36-20, right? First, it really depends on the time frame you're trading on, right? Because let me just show you. My goodness, we're almost out of time. Oh man, we're almost out of time. All right, so look at this over here. Okay, if I'm talking about the 1 hour chart, occupying almost the full screen from here to here, this is 259 pips. Okay, this is 260 pips. Okay, for making it easier for us is 260 pips. On a 4 hour chart, there's 260 pips, but you take the same size, right? You take the same size, something from here up to here, that is 422. This is 761 pips, right? So different time frames, right? This looks huge, right? But if you go onto the weekly chart, this is tiny, right? This is tiny, right? Because on the weekly chart, when you're looking at trades, right, you're looking at something like here to here, it looks small, but this is actually 2,400 pips. Okay, so your decision whether to use 90 pips or 50 pips or 30 pips or 10 pips depends on your time frame that you're trading on. If I ask you to trade 10 pips using a weekly time frame, you're not gonna. It's hard, right? Because what is 10 pips on a weekly time frame? Let's try to draw it here. What is 10 pips? All right, even with my mouse moving super small, I can't even pick 10. This is 10 pips over here. This is 10 pips on a weekly chart, right? But on a 1 minute chart, if you're talking about 10 pips, right? Let's see from here. This is 10 pips on the 1 minute chart. 10 pips on the weekly chart is like that. It's literally like this, right? So there's a difference. Depending on your time sensitivity, you pick a different style of trading. You pick a different amount that you want to kind of gun for when you trade. Now, importantly, when it comes to trading, right? The style I trade is scalping, right? So I always look out for the quick reversal. Let me see if I can find it here. So one of my favorite pairs I mentioned earlier is Aussie Franc. How do I trade this, right? So in this case, how we'll find a Fibonacci confluence is this. I'll do a zigzag from here. Okay. Now, who can tell me, based on this Fibonacci extension, which Fibonacci extension level is still valid, right? What Fibonacci extension levels are valid? 0, 23, 38, 50 to 1 to 7. Which Fibonacci extension levels are still valid? Why is so many people saying 61.8, man? 78.6? Come on, guys. If you answer, you get to learn. Go through the thinking process and see what Fibonacci extension levels are still valid. Tafatswa. That's a nice answer. We got Georgios too, answering very nicely. And Bruce is very, very honest. He has no clue. Well, We got Yogendra that's saying it's 127. Okay, we got a couple of people who are saying 127. That's true. And the correct answer is 127. Everything below is not valid anymore. Why is that so? This is your starting point. This is your middle point. This is your ending point. So you have already begun to project, essentially, let's see if I can get a replay bar over here. You're starting to project price upwards, right? So it goes to 27%, right? I mean 23.6%. Okay, and it goes to 38, and it goes to 50, it goes to 61.8. Every time it surpasses this level over here, it surpasses this level, it surpasses this, all this become invalid. All right, all of this become invalid. That is why, as you can see, you know, if it goes all the way up to 100%, right, it becomes invalid, 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 invalid. Right, that is how Fibonacci extension works. That's how Fibonacci retracements work, right? Is that if price breaks past it, as you can see over here, it becomes invalidated. So the only level that it has not broken past yet is actually the 127% extension. Okay, now I think that was a very important lesson for many of you guys. Can you use Fibonacci to trade on trend and not just reversal? So I got a question from France. Can you use Fibonacci extensions to trade on trends instead of just reversals? Yes. So so for example, if I were to try to trade on a trend strategy, okay. So we are seeing something over here. I'm sorry. We are seeing price make. You know, we're seeing price make you know, is going up, right? So we're making higher lows and higher highs, right? Higher lows and higher highs. That's always a sign of a trend, right? It's always a sign of a trend. So one good way to find one good way to kind of find more information about a trend is to put on an Ichimoku cloud. Holy smokes, that's messy. Forget it. I'm going to remove it. All right. So anyway, strictly speaking, you know, higher lows and higher highs means an uptrend, right? So we're expecting price to go up. How can you use Fibonacci retracements and extensions to play a trend? There are two ways. One is to look for the next area where it might bounce from, right? So in this case, right, if you're looking at, I just do an analysis on Aussie Franc over here, okay? Let's just say I'm looking here and this is the first time I'm doing it. I'm just going to look here. Okay. Can you see this? All right, price touch here, 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 here. 4 points. 4 points. We are looking at a channel. Okay, we're looking at a channel, and that means, you know, ideally we're expecting price to continue rising, right? How you can use a retracement and extension here is to figure out when's the best level price might continue rising, right? You don't always need to wait for price to kind of come down to test the channel before bouncing, right? Because price can just as easily go up and down and up and down, right? So what we do know is that in a channel, there's a higher chance that price will rise than to fall, right? Because it's a bullish channel, right? That's what momentum is for. Momentum is not for you to take the exact trade, right? Momentum is good for you to let you know where's the river flowing towards, right? Where's the current, you know, moving you towards, right? And it's better, is in some sense, it's better to trade in the direction of the trend, right? So in this sense, what I would do is I would do a Fibonacci extension. I'll do the nice little zigzag over here. True enough, send 8.6 very nicely. I'll do a Fibonacci retracement from here to here. And what I notice is that there's a very nice level here. I'm not sure. I'll remove some of the levels. Right, and I'm going to remove some of the levels from here to make it slightly clearer, right? But we can see there's a nice confluence area over here, right? And maybe, yeah, that's one nice confluence area, right? And maybe there's another 61 and 100% over here. So we got one area over here, and we got one area over here. Right. So if I want to continue playing the trend, there's what I would do is I would wait for price. I'll wait for price to kind of come down to here, and then I'll play upwards, or maybe come down to here and then play upwards. The best is, of course, when it comes down to this level and it lines up with my channel, right? Then it will give me the so-called the highest chance of a successful reversal, right? How these retracements and extensions can really work is to help you time your entry when the to go in the direction of the to go in the direction of the trend. At the same time, I understand what you're asking, Franz, is that if, right, let's see, if you're talking about instead of playing reversals, right, one very, very good way is that if this is a big level, and let's just say price kind of crawls around here, up and down, and it comes down to here. If you notice that your Fibonacci extension, your confluence area, is in line with a big trend area, and you don't want to kind of play the reversal, right? You're looking to try to play, maybe you see that price is going down from here, right? You're looking for price to go down. You can wait for price to break. If price is able to successfully break this confluence area, along with a confirmation whether it's channel or support or resistance, right? There's a high chance that, if it breaks out, there's a high chance that it will continue going further down, right? Because it's a very strong area, we're expecting a bounce, right? But if the bounce doesn't happen and it really breaks, right, that can be an additional confirmation that that price we're looking at a good reversal. The last thing that I want to share with you guys is I guess I focus a little bit more on the application part of it, right? So maybe we are at the 15-minute charts. One key thing about Fibonacci. One key thing about Fibonacci is this magical thing called a 23% retracement, right? From here up to here, we have this thing called the 23% retracement over here. If you're seeing price make a higher high, higher high, right? And it keeps going up high, there's this rule that for there to be a change in trend, right, price needs to break the 23.6 retracement. So if you're trying to play a trend reversal strategy, where maybe you're looking at you have something like this, you can see, right? This is a trend line where price is bouncing up one time, bouncing up two times, bouncing from here three times, right? When it breaks this level, right, not only does it break the 23.6 retracement, but it also breaks this ascending line. Then that confirms a reversal for you to 38 and even to 50%, right? So that's one way that you can combine Fibonacci with trend trading, right? And we got a question from Danny. In this case, where would you ideally set your stop loss? I'm not sure which example are you referring to, but usually, let me see. Usually I set it at structural levels, right? So technically, if I was on the 1 hour chart, right? If I was on the 1 hour chart here, and I was looking at something like this, right? The channel, right? The first thing hey man, there's such a nice level here. Looks like it's gonna bounce. Okay, never mind, I'll leave that for last, right? But if I was to, price comes down to here, right, and it really breaks out from here, I would logically, right, I would put my stop loss within the structure. That means it should not reintegrate into the structure, right? You need to think of stop loss placement as the logic behind stop loss placement and the logic behind trading. Why you're taking a trade, why you're playing a trade from here is because of this thing called a channel. Oh my goodness, yeah, it's called a channel breakout strategy, right? A channel breakout strategy requires price to break out of the channel and continue going down. Where should your stop loss be? The answer I want to give you, Danny, is that there is no fixed place there's no fixed distance I can tell you to put your stop loss. Rather, the way you want to put your stop loss is at a point where you can look at yourself in the mirror and say, my strategy, my initial idea is not working anymore. My initial idea of a trend breaking out from here is not working, and it has went back into the channel. I have been faked out. It was a false breakout, and now price is reintegrating back into the channel, right? So whether it's a channel, whether it's an overlap resistance, and you're going to play price downwards, any trading strategy, right? Your stop loss is at a point where you admit that I am wrong. My plan A is wrong, right? I originally thought it was going to be a bounce, it was going to be a breakout, it was going to be a channel exit, it's going to be a wedge, whatever it is. But basically, my original idea is not working out anymore, and I admit that I'm wrong, right? That is the concept behind a stop loss placement. Okay. Now, if I were to do one last thing, I guess, right, is this example here. I just realized it's so nice. Fibonacci extension, Fibonacci retracement. What do you notice, right? I would have played this scalping opportunity if I had saw it earlier, right? But there is a nice 78.6 retreat extension, a nice 38% retracement, a nice pullback resistance, a pullback support. This area is a very nice area for me, right? This area is really a nice area for me, right? I would play a trade that goes up to 23%, right? That means if I were to play a bounce over here, I'll be playing for price to come down here. I would enter here and get out at 23%, 23.6%, right? Because 23.6% is always the first big resistance level for me, right? So my take profit would, I mean, if you guys are in the trading circle in the Facebook group, right, you always notice that I get in and out of trades very fast, right? You notice from here 33 to 44 is about 10 pips. Take profit. My stop loss, I will put it I'll put it beyond the 88 and 50%. So I'll probably have it about here, right? So it's about 33 is about 14 pips stop loss, 10 pips take profit, right? Assuming that your entry is right over here. The risk to reward is about 1:1, right? But that is how I look for trades, right? I look for it in advance. I see it coming before I take the trade, and I'm only looking to play a small little bounce, right? Remember what I shared with you earlier, right? Remember what I shared with you earlier on this, right? It is not about the number of pips you make, it's about the risk to reward of the trade, okay? And yes, I use limit orders for entry, Zion. I almost exclusively use limit orders for entry. Now, guys, we are starting to overshot. I don't think I have time to talk about the part on strengthening your strategy, right? But what I do want to encourage you to do is that go to exittrader.com, education seminars and webinars. Right, next week we're using correlation to improve your trading strategies. We're getting more and more advanced. Right, I know we got a question. We got a question asking where can you watch your previous recordings. It is at the end of everything, right? So after 6th of August, there'll be Evgenia will be compiling everything, right? And yeah, should make it available to everyone, I think, right? But I hope rather, right? So yeah, just be sure to tune into the next 2 webinars. Correlation, super advanced, right? It's gonna be crazy, right? But this last, if you guys have been traveling with me like Emat, you know, from the beginning of the webinars until now, you have learned so much about using support resistance, hidden RSIs and stochastic, Fibonacci retracements, extensions, price action, all of that to trade better. And we're going to tie it together with correlation and picking stop loss and take profit target. So be sure to sign up for those. That's it for me. It's nice to see that you guys stayed all the way through. You know, once again, trade safe, stay safe, and peace out, guys.